Holy flippity flip-flop-flap and smokes, everyone. We need to talk about right now what the Federal Reserve just said, what they've just done with interest rates, and we've also got their summer of economic projections to tell us what they think is going to happen in 2023. So everyone, we've got a lot to cover in today's video. This is a quick urgent update just here from the car today, but this is so urgent I wanted to get out to you as soon as the market closed. So let's get into it. Okay, so first things first, stating the obvious. We got the CPI report yesterday. It came in at 7.1%. That was slightly smaller than expected. So inflation is starting to come down, which is pretty good. We've been experiencing crazy high inflation for a while now. But the thing is, prices are still going up. Prices aren't coming down. They're just not going up as quick as they were before. But we've seen this happen before. We saw this happen at the start of the year when, Biden said, look, we had 0% inflation, or it just went up an inch, only for it to go up about another 1% every month for the next 3 months. So we're not out of the woods yet. And the Federal Reserve just had their meeting, and they spoke with the media. They had their press conference, and they confirmed this. They said, look, yes, the past two CPI reports shows that inflation is coming down, but it's still 7.1%, people. It's still more than triple the Federal Reserve's mandate. And also in their summer of economic projections, they expect it's still going to be over 5% next year, 2023, and it's still going to be over 3% in 2024. And this is what I've been trying to warn people about, that once inflation goes as high as it did, it can take 5 years for it to go back down below 2%. Okay? So inflation isn't going to go back down to 2% next year like everyone hoped. Now also, what they did, they announced that they're going to be lifting interest rates by 0.5%, or they did lift interest rates 0.5%. So now the federal funds rate is 4.25 to 4.5%. So some people were hoping that, because the past 2 months CPI reports have come in a bit lower than expected, they were hoping that maybe they only do a 0.25 percentage rate hike. Also, what the markets were hoping is, they were hoping that the peak rate of where the Federal Reserve is going to go to, the dot plot, or their projections of what they think interest rates are going to have to go to bring down inflation, would be lower. But no, they're still coming out saying, no, we're going to have to go to about 5% to 5.25%. And again, people, that's what I've been calling for all year on the channel. Remember at the start of the year in January, they said, okay, guys, inflation is not transitory anymore. We'll have to lift interest rates. But at the start of the year, they projected interest rates would only go to 0.75% or 1%. I've been saying, look, if they want to have any chance of getting inflation down, they're going to have to go to minimum 5%. And I also warn what will happen if they go to 5%, that we're going to face a severe recession. And I think it could be possible that we could face a depression once we see things in the financial system start to break after they leave interest rates at 5%. Now, a lot of people may be saying, well, look, yes, we've had a crash in the markets. From peak to trough, the S&P fell around 27%. The NASDAQ fell over 35%. We're seeing more and more stocks crash lower and lower, down 90%. A lot of the tech stocks that were booming in 2020, 2021, we're seeing right now Tesla's getting absolutely annihilated. And I think it's more like the global elites are coming after Elon Musk for what he's doing. But this is just an example that Tesla, even though it's come down over 60%, is still severely overvalued with a PE ratio of over 45. So it still has a long way to go. So again, people, some other economic projections the Federal Reserve gave when they were giving their meeting. They said that they think GDP growth for 2022, this year, will only be 0.5%. And I think they said they only expect that for 2023 as well. So that's pretty much, when you factor in inflation, people, what you have to remember, because, this is numbers. This is just economic numbers indicators. This is their books. They're doing some creative accounting. But if you look at the real world, if inflation's 7% and GDP growth only 0.5%, Well, that's actually more like negative 6.5%. And that's why you're seeing people saying, this feels like a recession. I'm worse off. Things aren't getting better. Because in real terms, people's pay is going backwards. Yes, they're saying, look, it's so great. Wages are going up. But in real terms, prices are going up much faster than wages. And you know something that's quite funny? I think it's quite hilarious. And it shows why the rich keep getting richer and the poor getting poorer, because the system is absolutely rigged against you. Think about this. In 2021, in 2020, they gave you heaps of money. They printed money like crazy. And who got the money first? The banks got it. The hedge funds got the money first. So they could use that money before we experienced this crazy inflation. It's called the Cantillon effect. Whoever gets the money first, they benefit the most. Then it starts to go to the businesses, the small businesses, and then it slowly, lastly, goes to the employees. They slowly start to get wage increases. And what's quite funny is when the stock market was going up 50-60%, there was no issue. When the housing market was going up 40%, when rents were skyrocketing, when fuel costs were skyrocketing, groceries were going up, it was no issue because the banks and Wall Street are making lots of money. But now that the employees, they're saying the big fear is a wage price spiral, it's funny how they're saying, well, look, there's too much jobs in the economy now. People's wages are going up too fast. So what we need to do now is crash the economy. That's right. It sounds like a joke, doesn't it, people? They're worried now because there's too much jobs in the economy and the wages are going up too much. So now they're only going to want to crash the economy because the little guy, the poor and the middle class, is starting to gain more wealth. Now, yes, why that does contribute to inflation, and yes, why inflation is very bad and it will have much worse long-term effects if we experience hyperinflation. It's just quite funny how, if you think about it in those terms, it's okay when the rich are benefiting from this economic boom, but as soon as the poor and middle class start getting a bit of that pie, the central bankers have to come in there and destroy the party. And also, how they keep getting richer. Remember, at the start of the year, I was doing lots of videos on this. All these central bankers, they all sold their stocks right at the peak. A lot of CEOs in January, they were selling stocks at record levels. I was covering this. All my subscribers will remember this. So they get the money before the high inflation. Then when the central bankers are about to crash the economy, crash the markets, they sell. And then they wait for the retail investors, the mum and pop businesses, to go out of business, and for all other people to force having no other choice but to sell the assets, and then they come up and buy up everything for pennies on the dollar. So that's how the system's rigged against you, people. But if you know the game, if you know how they play it, you can also take advantage of this. And I know many of you will. So this comes to the question now. What is going to happen in 2023, in my honest, humble opinion? Again, there's no guarantees. There's only probabilities. What I think is going to happen, everyone, right now we're seeing a lot of optimism because the Federal Reserve is slowing interest rate hikes. But remember, this is not a pivot. The Federal Reserve has told us they're going to slow their interest rate hikes because they said in their press conference today that they've done a lot of rate hikes, or they've lifted rates so much that they haven't felt the effects on this, because interest rate hikes have a lag effect. So we haven't felt the full effects of these 4.25% interest rate hikes yet. And we still have about another 0.75 or 1% to go. So what's going to happen in 2023, we're about to feel that pain. We're going to feel like we just been hit by a freight train. The economy's going to feel like it just got hit by a freight train when we start to get the economic data to see how damaging these high interest rates are having on the economy. And also what's been happening in the bond market is the bond market has been going down. So that's kind of helped the housing market. But once the bond market gets a picture that the Federal Reserve is not going to pivot anytime soon, I think bond yields are going to start going back up again. And then that's going to have negative effects on the real estate market. But the biggest risk, I think, for the stock market in 2023 So like I've been warning about Q4 and Q1 earnings. They're going to absolutely plummet. They're going to be terrible earnings, okay? This Christmas season, I think, is going to be one of the worst in decades, in real terms. Yes, it may go up a little bit because of inflation, but when you factor in, when you take out inflation, I think in real terms, it'll be one of the worst Christmas or one of the worst holiday spendings we're seeing. So, put it simply, what you're wanting to know, what all these economic indicators mean for you in simple terms is companies' earnings are going to plummet. People's savings are dried up. The US personal savings rate has dropped to 2%. Credit card debt's at all-time highs. That's going to get maxed out in 2023. These interest rates on these credit cards are going to get astronomical. Some people are now paying 30% for store credit, which is absolutely crazy. And we're going to see some big financial institutions go down, I think. We're seeing what's happening with Blackstone, with retail investors trying to get their money out of the REITs. They've hit their redemption limits. They can't get their money out. We're seeing cryptocurrency firms collapse. But what's going to cause the real big financial crisis is we're going to have to see one of the big hedge funds or one of the big banks go down. So I don't think we've hit the bottom yet. Remember, be patient, people. The market can be irrational longer than you can remain solvent. That's why I never short the market. So I'm patient. Again, I've been calling for 35% decline in the S&P 500. That's where I'm waiting for to start buying up. If you do want to start deploying some money now, if you've paid off debt, you've got your emergency fund, you want to hedge yourself against this risk, again, not financial advice, is what I'm doing. Gold and silver, I've been telling you guys to buy that since around $1,600, since around $19 for silver, and that's been outperforming the market. So, you know, some people say, you know, gold and silver can just be boring. Why? It can be boring if you buy at the wrong time. If you buy at the right time, it can make some great, exciting gains. So again, people, more pain coming. The S&P going down. 2023, the housing market, we haven't seen the real pain in the housing market yet, but in 2023, we're going to see that. And it's also going to be very interesting to see what happens with crypto, with the fallout of FTX, and if Binance has any issues. I don't think we've seen the bottom for crypto yet. I'm waiting for around anywhere between 12 and 14,000. That's where I'm kind of waiting for Bitcoin until I start dollar cost averaging back in. So that was just a quick update with what's going on with the Fed, some of my thoughts for what could happen in 2023. What do you think about this? Let me know. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.